For decades, the global economy has operated on a single, unquestioned premise. The US dollar is the ultimate safe haven, and gold is an outdated relic. But beneath that stability, the cracks are finally beginning to show. On June 24th, several of China's largest financial institutions, including the Industrial and Commercial Bank of China, abruptly suspended paper gold trading for their retail customers. If you were a Chinese citizen trading gold contracts through your bank, your access was effectively terminated. The official explanation from Beijing is a protective one. Gold reached record highs earlier this year before dropping sharply, and the government claims everyday retail traders need to be shielded from this extreme volatility. But the government's own actions tell a different story. While they are barring citizens from the market, the state is aggressively hoarding the physical asset. In a single month, China's central bank acquired 163 tons of gold, one of the largest purchases in its history. This creates a bizarre double standard. The state is protecting its citizens from an asset it is simultaneously treating as a top strategic priority. This banking update signals a deliberate pivot toward a world where physical assets matter more than paper promises. To understand China's move, we have to look at how global gold prices are actually set. For decades, the Western financial system, centered in hubs like the London Bullion Market Association, has dictated the value of the metal. In these markets, the majority of what is traded isn't physical metal, it is paper gold, digital contracts and certificates that represent a claim on a gold bar. Most investors buying these certificates never intend to actually take physical delivery. Because physical delivery is so rare, financial institutions can write 10 or 20 paper claims for every single gold bar sitting in their vaults. It is a system built on the assumption that everyone won't show up to collect at once. This chart shows the mathematical result of that system. When the market is flooded with millions of paper claims, it creates an illusion of massive supply. That artificial weight suppresses the true market price of the physical metal. This creates a fragile reality. If every contract holder demanded their physical metal today, the system would find itself short of gold. The majority of those paper certificates would be revealed as worthless. The Western pricing system thrives on the disconnect between physical metal and paper claims. By removing speculative paper trading from its domestic market, China is attempting to isolate the signal from the noise, seeking a version of the market where the price is set by the metal in the vault, not the paper in the air. This strategy goes beyond simple regulation. For over a decade, China has been systematically dumping hundreds of billions of dollars in U.S. Treasury bonds, effectively divesting from the American debt market. They are rotating that capital into physical gold. Central banks worldwide are currently buying gold at the fastest pace in recorded history, and much of this shadow accumulation is happening without being officially reported. This metal is flowing toward a new financial infrastructure. The Shanghai Gold Exchange is built on physical delivery. Unlike the Western markets, when a trade happens here, real metal must move, ensuring that the price reflects actual physical scarcity. To support this, Hong Kong is massively expanding its physical vault capacity from 200 tons to over 2,000 tons. This expansion provides the storage necessary to handle a global trade system that settles in real metal rather than digital promises. By forcing physical settlement, China is positioning the yuan as a gold-anchored currency. It offers the world a parallel financial system, a way to conduct global trade that doesn't rely on the US dollar or the Western banking network. How does the current superpower respond to a gold-backed rival? To find the answer, we have to look at a hidden asset on the American balance sheet. The United States officially holds roughly 8,000 tons of physical gold in its sovereign reserves, the largest stockpile of any nation on Earth. But those 8,000 tons are valued using an accounting rule from 1973. Legally, the U.S. Treasury still prices its gold at just $42 per ounce, a fraction of its true value in the modern market. This chart shows what happens if the U.S. simply updates that rule. Revaluing the gold to modern market prices would instantly add over $1 trillion to the Treasury's books, creating a massive pool of wealth without issuing a single new bond. This revaluation would allow for the Judy Shelton proposal, a 50-year U.S. Treasury bond that could be redeemed in either dollars or physical gold. This strategy mirrors China's exactly. By reestablishing a link between the dollar and gold, the U.S. could provide the same stability China is promising, attempting to maintain global supremacy by moving to an asset-backed model. The era of fiat paper funding endless expansion is meeting its limit. Whether the world trades in yuan or dollars, the future of global power is returning to a reality backed by physical assets.